Even before the COVID-19 outbreak led market disruption, the stock of Axis Bank had underperformed its peer ICICI Bank by a big margin. There was a 48% rally for ICICI Bank against a 20% rally for Axis Bank in the year 2019. In our Ideas for Profit today, I'll talk about whether Axis Bank has in it to weather the current storm and give potential returns in the long run. Now, for the banking system, credit growth has already fallen to an abysmal level of 6% and will continue to struggle as the economy is unlikely to come back to pre-COVID level in a hurry. The corporate asset quality issues that was nearing its end will rear and its ugly head once again. Retail, considered a sweet spot in the banking industry for long, might not remain insulated as large-scale retrenchment across industries could raise the possibility of retail delinquency, especially in the unsecured pockets. While each of these concerns are valid, the 60% decline in stock prices of Axis Bank in the wake of the COVID-19 outbreak merits investors' attention. Now, gross slippages were elevated in the December quarter as close to 18% was from the investment book. Also, retail slippage was a tad higher and 81% of the corporate slippage was from the identified sub-investment grade pool, with 19% coming in from outside. Now, the COVID crisis will only make asset quality matters worse before turning any better. Now, we are factoring in a much higher slippage in FY21 to the tune of 5.5% of advances and the long-term average being 1%, albeit the moratorium and expected a very weak financial performance in the year FY21 as well. Now, the only good news is that high provision cover with technical write-off at 78%. In addition, it also holds extra provision of over 2,500 crores for various contingencies, which is not part of the provision cover calculation as well. Now, we still draw comfort from the fact that the new management of Axis Bank has been steadily trying to make the business granular and de-risked at all. Now, the risk management practices within the bank have also seen a revamp and all the senior hiring has also been complete. Now, in terms of diversification, the book has a 36% exposure to corporate, 11% to SME and 53% to retail. Now, the incremental in lending quality too has been improving as reflected in the rating profile. The bank has been degrowing its overseas loan book and defocusing on the riskier SME, which is the small and medium enterprises segment, as well. Now, the share of unsecured lending, which is personal loans and credit cards, is close to 17% of the retail and 9% of the overall. Now, the bank has an enviable liability franchise with a share of CASA at 41% and CASA plus retail term deposits at 82%. Axis Bank has a competitive cost of deposits at 5.3% and cost of funds at 5.4%, which should enable it to onboard better quality assets going forward from here. Now, with some of the private sector banks losing credibility in the recent times, the stronger survivors like Axis are in a vantage position to win market share. Axis Bank had raised 12,500 crores by way of QIP in September 2019. It has therefore got adequate capital support amid this kind of a crisis. And this should enable the bank to harness growth opportunities post the crisis in the light of weakness in government banks as well as the NBFCs. Now, the average valuation at the bottom during the previous financial crisis was close to 0.83 times 1 year forward adjusted book. Now, given our current estimates, this valuation corresponds to a price of 253 rupees per share, which is a 22% downside from the current levels. Now, investors must therefore add Axis Bank gradually amid deep cuts in the market.